feel free to,
Um,
talk about anything, but yeah.
or share my screen as well.
Yeah, yeah, of course.
Share my screen real quick. The entire window.
Have you managed to get the recording set up, Sammy?
Yeah, it's recording now.
Cool.
Beautiful. Everybody see my screen?
Yeah.
All right,
Uh,
beautiful.
so yeah.
Yep.
My name is Deontae, and I've been trading for a total of 7 years. I've been swing trading for 2 or 3 years now. Out of that, I started off as a day trader, and became profitable. And then at one point, things in the world started happening. I started off just with technicals only. Before COVID happened, I would say I was very profitable, and then um, I started a losing streak. I lost 10 trades in a row, which was the most I lost in my career, and I had to go find out why and what happened. Why were my trades going against me now? And I got introduced to fundamentals and the things that move the market essentially, um, and studied those for a few years, and then ended up taking on swing trading because I felt like it was more beneficial to me, and I kind of liked it more resonated with my personality. So from that point, in fundamentals and started swing trading profitably. Some things about my strategy and what I consider for trade going that direction is very heavily surrounded by central bank policy, and that is the reason for that is because central bank policy use currencies. I specifically trade forex, and I do trade gold as a commodity, but that's as far as I go. I have experience in like Nasdaq and SPX 500, so once in a while I'll take a trade on those. But my primary focus is on forex trading, and that's the one commodity that I do trade, which is gold. So the reason is because gold the fundamentals are easy for gold. There's only a few things that affect it, and it's a really good hedge for uncertainty and things like that. Um, So when I am looking at, and I'll pull up the economic calendar real quick as well, looking at what I consider for fundamentals and what moves the market, and these things do that I'll be talking about will affect different markets. They affect indices, they affect crypto, everything, pretty much every market. They affect stocks, everything. So today, for example, we had U.S. inflation coming out, and it came out as been expected. And I have to explain to you before I even proceed from here why this is important. Because a lot of people see the economic calendar when it comes to trading every week, but they don't know what any of these data points mean and how it affects the currency. And that is essentially fundamental in a nutshell, is that all of these small data points that you see for all these currencies throughout the week point to either two things that a central bank can do, right? They're either going to be hiking rates or they're going to be cutting rates. All right. So hiking rates typically, the reason why they would have to do this is because maybe they have inflation is too high, so CPI will consistently come out sticky, and continuing to raise and things like that. Maybe they have um, things like um, growing GDP as well. That's not reason to hike rates. If you have growing GDP in your country and sticky inflation, that means that you don't have to cut rates. So there's two things that central banks have a responsibility to do, and they have a dual mandate. And this is in every country. Every country, respective central bank, has to balance unemployment, and they have to maintain what's called price stability. So that's inflation. Obviously, if there's no governmental jurisdiction in place for keeping inflation in check, then inflation would just be able to do what it wants. Um, and then people would be screwed because their money wouldn't be worth anything after inflation was done with them. We've seen this in other countries where that has happened to us today, even where inflation is so bad that they're basically just burning all the money because it's not worth anything. Um, that just means that they weren't established enough to have a central bank to actually do anything about that during those times, and maybe they didn't have the resources for that. But anyway, they have a dual mandate to balance employment and price stability. So I just told you what price stability is, and those are their two only mandates, and that's their whole function. And if the employment in the country is slipping, for example, that's a reason to cut rates. Cutting rates brings jobs and things like that into the country. Cutting rates boost GDP and things like that for the country. If GDP is slipping, that's another reason to cut rates, by the way. So if factory orders are down, that's another reason to cut rates. If they're in contraction, for example, I'm trying to tell you all of the positive and negative data points for hiking rates and cutting rates real quick. If retail sales are down, people are not spending money in the country, it overall shows a economy in a recession, a country leading into a recession. You have all these data points that are looking negative, essentially, um, and the Federal Reserve or whoever that respective central bank is for that country, they're like, okay, we have to do something about this. Inflation is too high, the labor market is suffering. They have to balance that dual mandate, and whichever one's going to be worse. Like for example, we have a weakening labor market, and in the United States here, and as of today, we have declining inflation. Even though this is delayed data, it's significant. And we have declining inflation. That's a reason to cut rates because everybody had what's called global inflation during COVID. I'm sure everyone remembers things going from very normal price to very high price. Inflation got to the groceries and housing and everything like that, pretty much across the world. So everybody in the world during COVID and post COVID had to deal with what's called global inflation. That's when a major event happens, like a pandemic, a war, a major war, or something like that, and inflation goes up by default. Things get more expensive, things like that, and you have to at that point hike rates to tame inflation. That's the whole point of hiking rates, is to tame inflation, right? It's the main object. So hiking rates does make the currency appreciate. And I have to cover this before I get into anything else so that you kind of understand the ecosystem fundamentals that I'm referring to. Hiking rates, and this is the simpler terms that I'm explaining this in. Hiking rates makes a currency go up. That means that any data point that points to hiking rates also by default is bullish for that currency, and vice versa. So if you have declining inflation, you might have to cut rates. You know what I mean? They expected inflation to be actually decently sticky, kind of holding, but it did not. It declined in two major areas, especially the year over year. It shows a long-term trend of declining inflation. That points to Federal Reserve rate cuts. So prior to this, the Federal Reserve was very worried about sticky inflation. They got some delayed data, but nonetheless, it shows them to be having to cut rates. So you go here, and I know that affects that currency. The dollar, let's just close all of the rest of these so we can just focus on the dollar. The dollar is a loser for the week because of that. We had some weak labor market data as well as declining inflation. And if you just refer to what I just told you about how that affects the currencies and what that points to is the respective central bank here cutting rates. So that makes the dollar go down. The same is true for the UK right now. The Bank of England is concerned about the labor market right now in the UK, and then they just had labor market data. They had a surprise dovish Bank of England split last week where they voted mostly to cut rates. So the reason why the vote matters in their cases is they have board members who vote on whether to hike or cut rates based on what's going on, as I just explained. And if more people vote to cut than to hike, for example, or analysts expect it to be 7-4 vote on hiking, and then it's the opposite, it's a 5-4 vote on cutting, you know what I mean? Then that makes it more dovish or bearish for the currency, that meeting. And you can see the dollar still dropping literally as we're watching this. It's negative 101 because of that. So at that point, really, if you're trading just purely Forex, what really matters, and there's a few other things that matters obviously as well, but what really matters is the main thing that matters is what the central bank is doing and how the economy is doing. Obviously, that is what affects the valuation of the currency. So these economic data points here point to either hiking or cutting. So if we go back to last week, just for example, just one more example, we had the come on, the dovish Canadian dollar. Let's go the second to the 6th. Where was it at? Let me find it real quick. I believe it was later on in the week. And also last week, to add to that, week ISM manufacturing. Week ISM and manufacturing. Make sure everybody's still here. Beautiful. Yeah, week ISM and manufacturing as well. So even though it came out still out of contraction above 50, They expected it to come out at 65, and it came out lower than consensus, showing weakness in the economy. There's a few good ones, but overall, that was kind of mixed data. Where is that Canadian dollar labor market? We have the Australian dollar unemployment, New Zealand dollar unemployment, and things like that coming out last week as well, and their unemployment rate in New Zealand actually ticked up from 5.3. My bad. Last time to 5.4. They expected it to be stagnant. And if you remember what I cited about labor market and their dual mandate, these would be very data points. If their unemployment rate is going up, that means the labor market is weakening itself at that point. So they really looked at this data point as like the labor market is weakening because there's more people filing for unemployment, which means that there's obviously less jobs.
So I have a quick question, Deontay, about the recent data that just came out. We had three green scores, better than expected news. Has that changed your opinion on the dollar, to whether they're going to cut interest rates or keep them the same? Because, like, which is I think really important for everyone to understand. If you notice at the end of every sentence that Deontay says, he says if interest rates will increase or decrease, because that's basically what matters. You need to have some sort of picture in your mind that says, does this data say interest rates will increase or decrease? And with the recent set of data, what's going in your mind with the US dollar now? Do you think it's going to continue to weaken, or do you think actually the Federal Reserve may hold rates? And I know there's lots more with the war story and all that stuff, but what's your thinking from that? Because I got quite confused because there was a big reaction on the DXY, and then of course
Yeah.
nothing really, it kind of fizzled out pretty quickly, if you see what I mean. So, what's
Yeah.
your thoughts when you see data like that?
When I see data like this, like, do you mean the labor market data today, or no, the
Oh,
inflation data
sorry,
today?
the other day when we had unemployment rates, we had, I think it was NFP day.
And I see
Well,
that. Let me go there
I
real
think it
quick.
was yesterday. It's three green, better than expected scores for the US. Here we go.
Yeah. So here we had it was at 232K last time, and this is initial jobless claims. Is how many people are claiming that they don't have a job. It's in the title. So they came out at 232K last time, and we did
Yeah,
have it coming and they expected it to be at 222K. So they expected a decline. They came out at 227K. So that is better than expected. We did have a pretty nice reaction, but but what really struck them was that this data point, it came out at 1841 last time, and they expected it to increase, but only to 1850, and it came out higher than expected. So the market kind of focused their attention more on this because even though this came out better than expected, they're looking a little bit deeper. The continued jobless claims are increasing actually. So you have to, look kind of like this is like a look into kind of this guy right here. Maybe it comes out better than expected for a few reports, but then at some point this is going to manifest if people are continuing to, you know, if we keep having reports of this coming out. And lately we've been having overall the reports for the dollar and the labor market have been weakening. It's just been weakening very slowly over the past several days. So that's kind of how I interpreted that. And then I actually look at the actual reaction for the dollar at the time, to see what the physical reaction is versus my interpretation of the fundamentals. Because I am wrong sometimes, and I do interpret things incorrectly every once in a while. But I kind of like looked into this, and they were continuing to have jobless claims, even though the initial jobless claims increased. I would kind of be a little bit skeptical of this data point right here because of this one right here. If this would have came out better in line with this, then that would have just truly been flush across the board good news. Because I would consider this very mixed data as well. And then we had the 4 week as well, averages as well. I look at all these data points for that. 212K last time, and then it came out at 219K. That means in a 4 week average, more people applied for unemployment essentially, showing 2 out of the 3 data points right here being pointing to more weakness. So I would kind of be skeptical of this one at that point because these two are not lying. At that point, I would kind of view these two as like a deeper look into of the underlying trend. If I would even had 2 out of 3 of these being positive, then I would have been like, okay, yeah, maybe the labor market's not doing doing as bad as people thought that it was because of past data from the labor market as well as just continued jobless claims and 4 week jobless claims on average. in increasing, uh, I would say that that's bad news for the dollar. Now, to top that, we have that declining inflation today, which is what the Federal Reserve was worried about in the first place. They were worried about whether inflation was going to be a problem, and they didn't want to cut too early. That's pretty much was the last thing that was stopping them from cutting. Because if you do it too early, you screw the economy. So that's why they're kind of trying to be a little bit precise with their moves. So I think today, even though this was delayed data, it confirms the underlying trend of inflation. And now, based on that, real quick, based on that, we will the Federal Reserve's probability for interest rates may have cutting rates may have gone up, because this all determines what's going to happen in the next meeting, and then obviously the forward guidance moving forward as to what they're going to do. And typically, I don't trade the moves. See, they're still saying 94% chance of a hold, but I guarantee you, next week when we updates and more data comes out, and more labor market reports come out, unless they improve from this last, and especially the inflation, unless it becomes suddenly sticky and you have a continuous trend of continuously high CPI reports coming out. Um, I don't think that the dollar, I think they're going to start to begin to get more aggressive about cuts. And I essentially trade off the data. There's opportunity for entry at every one of these data points right here in the event calendar that points to either interest rates cuts or interest rates hikes. So at that point that the data came out, I did look at Euro USD. Um, and at that point, I look at technicals. I start to look at data and technicals both. So we go back to the home page, and I'll look at what data I consider. So all in all, I use whether the interest rates are going to be raised or um, cut, basically, at that time, because I know that that's what affects the currency, and I know that underlying to that, right, and across more micro to that, smaller picture to that, all of this stuff on the economic calendar points to either one or the other, which influences the currency. Um, and it makes money move as well to the currency and out of certain currencies as well. And once you learn where the money flows in the market, it becomes really easy to gauge moves. And we'll cover that too. As a matter of fact, let me open the tab. This is going to be kind of like the crazy banger for this webinar, this tab right here. I'm gonna keep going in a second. At that point, I look at data. So I looked at Euro USD, and here's a few data points that I consider myself personally. I've been using Prime Market Terminal since before they were even Prime Market Terminal. They were seasonal Prime, and they weren't even out yet to the public. I got lucky, and for DM the guy that I saw a little snippet of it in his story, and um, asked him what it was, honestly. At the time, I was unprofitable. I was semi-profitable. I could return like break even at 2% a month most times, but I wasn't like profitable as I am today. And he basically let me know like you have to have data in order to back your trading decisions or your gambling. And I was like, bet. And from there on, it's been this. So um, let's go to DMX first. I like to look at that first. These are retail traders. These are the average traders, all the volume of the market of your average everyday trader that loses like 78.5 or 79% of the time. I believe your average retail trader loses. So I use this as an incentive to trade against them. Whenever fundamentals are long for a pair, they will go short, and vice versa. They'll trade against the current fundamentals. And I like to look at the sentiment, even though we're 62% short right now, which is what I do. This is what I want to see. I want to see them trading against me. Euro USD is long right now from that last bit of data that came out today. And I can see right here, overall, they have an interest in decreasing their long lots over time. So that means that the increased interest would be the shorts. You can't, these are, this is data from them, and this refreshes every like 5 to 15 minutes. So I get to see that, and I use that as incentive to trade against them. I use seasonality as well as the COT report as well. And I had already dropped Euro USD as a trade idea, but it was short at the time. I took it off of a data point that came out for like a few percent. Um, let's see here. Boom. So this is their net percent for their position. This is leverage funds. These are the big players and their positions. And I like to follow what they do a lot as well. Um, if the central bank for the United States, the Federal Reserve, is cutting rates and more data comes out that supports that continuously from here, then that is opportunities to about add positions, things like that when you're swing trading. So since central bank policy is not week to week, it is very long term. A central bank policy can be the same for years, and you might be able to scale it something for years. For example, the gold rally that's been going on for like the last 3.5+ years. Imagine if you would have got in on gold 3 years ago and just been adding positions all this time. So just based on the things that affect gold. Um, so we have 1.2%, and anything for perspective, anything zero is the middle ground. Anything below zero is negative. That's a short position. Anything in the positive is positive. Um, Long story short, so you can see it, and this is week by week here. They've overall been adding long positions to the euro. Let's just say the last 3 weeks, coming from positive 5.8%, and then they decreased their long exposure, and then they started increasing again because the fundamentals right now for the euro are pointing long. And you can see here on the graph, this is the same data reflecting as well. And then down here, we have the dollar. It's the same data week by week by week. You can see here that they were negative 14, and then they were 1.2. And then we had some labor market data come out from last week to this week. So they increased exposure to the dollar. But still, overall, you can see they're more net positive on the euro. So with the CPI data, I would expect next week's data to have a decreased exposure more to the dollar. Um, Positive 2.7%. Overall, the trend is going to be that you're going to decrease exposure to the dollar. Um, I like to do what they do as well and kind of consider that. And I also use bank research as well. I use seasonality as well. Let's get a seasonality report, showing you a few data points and kind of what they mean and why I consider them. What does seasonality even mean? A lot of people don't know what seasonality means or don't use seasonality. This gauges back the last 20 years of data on this pair, and um, let's just say 10 out of the last 20 times, or 80. Let's just say 80% of the time overall in the last 20 years. This has been bullish in January. Let's just say, for example, and you can see right here the months. So February, typically this time in the last 20 years, in February has been bullish. Currently, it's bullish. Seasonality is currently on my side as well for this trade. And it's kind of like a thing that they studied in trading that they see that works a good amount of the time in terms of directional bias. It's not always that you have seasonality in your favor. Sometimes fundamentals change and things like that. But that's like, that means you have an 80% chance of this being bullish in February this year. So this is 15 years of data. You can go back 20. And that's basically increases your probability and odds essentially. It's like a it's almost like a formula they came up with for if you want to get more detailed and do more research about seasonality and for how they calculate seasonality. But that's basically the simplicity of it. Is like in the last 15 20 years, it's been bullish in February. Let's just say 14 of those times, that's 90 something percent. You know what I mean? Of those times, it's been bullish. So you can go back and look and have seasonality and say, is seasonality on my side? Okay, now I know that in February, in the last 15 years plus, it's been more often than not bullish. And I'm going to consider that for my analysis. So it's kind of like a more advanced sentiment thing with backed by a little bit of real data, a bit amount of real data actually. And honestly, those are the only things that I consider. I do have as well. I also consider I have the Dom. I use the Dom to enter my trades to kind of see order flow going where it needs to go as well. Um, and then I read Bank Plus as well, JP Morgan, Goldman Sachs, things like that to see what they also think about the trades as well. So I read these, let's just say, dance or something like that. Or let's just build this one, for example. I don't use AI because I have my own brain. Don't need AI. Human brain's capable of much more than AI, honestly. If you really think about the facts of the human brain, it's smarter than any supercomputer, has more processing speed than even the smartest supercomputer. So let's pick a different article. Something that's more forex focused. So they're showing you their opinion on their macroeconomic forecast for these countries, the euro area, 2025, 26, 2026, 2027, the GDP, and notice how the data points that they're showing you that they're looking for to grow or not grow are that point to either a contracting economy or not. Um, are the same ones that I had mentioned earlier: inflation, imports. As well, I was saying the factory orders, the imports, exports, things like that. Obviously, if you're not exporting in for profit and you don't have profit and your exports are down, that means that other countries are not doing business with you, and that's going to eat up your GDP real bad. You're not making money. So you have to kind of connect the dots where and learn the things. What's imports? What's exports? Why does that affect GDP? Obviously, you're not making money as a country if no one's doing business with you. Inflation, if inflation's too high, they're going to have to hike rates. If wage growth is down, they're going to have to cut rates. Things like that. If unemployment keeps ticking up, they're going to have to cut rates. So this is their projection for what's going to happen on each of these individual data points for these countries. And you can just keep going down the United States. So you can look at Euro USD in detail and see what Dan Steph thinks about this. And then do you agree with that yourself? And then if you do, then you guys kind of are in sync with your idea. It's not about just getting trade ideas from bank reports, even though that does happen. They'll literally say, hey, we're buying your USD because of these reasons. And here's the entire breakdown. And you're like, I agree with that. I'm going to take that trade. That's fine. There's nothing wrong with that. You're literally getting institutional insight from the big players on what they're doing. But I like to think with my own brain as well. I'm kind of have more critical thinking in my trading. So if I don't agree with the idea, you know, it might be a fire breakdown in their bank report, I'm not taking that trade. But this is just for like added confluence onto your trade when you have, let's just say, two or three institutions all agreeing that your USD is long at the same time, plus your own analysis. It kind of gives you more confidence to execute when you know that the big players who move billions and millions of dollars are at a time per trade, if not more, depending on the size of the institution, um, what they're doing because they're not playing to lose. So, and these guys also swing trade themselves. Does anybody have any questions so far? It was a lot of information, but I had to break it down in a way that would kind of flow well, where you know exactly what I'm talking about when I say these things affect the interest rates and these things affect the evaluation of the currency. Does anybody have any questions
I
so
have
far?
uh, I have two questions I want to ask. Number
Okay.
one is obviously the central banks they control the interest rates, but they
Yeah.
also manage their balance sheet. So you know with like QT and QE. I was just wondering
Mhm.
if that factors into your analysis. Yeah, that's my
Yeah.
first question.
Okay, yeah, yeah, it does. I pay attention to it, you know, when my New York market or I like to New York session mainly. Um, but in my New York market open briefings, I'll read about it. If he's doing like a balance sheet runoff, you know, and he's if the Federal Reserve talks about doing that, I consider that because that does affect it will affect the currency. Um, and if if yields are down because yields affect the currency too. At the same time, or if yields are down, the currency is going to be down, and vice versa. So if there's no fundamental context or no big economic events for the week for a currency, typically yields will take over, or geopolitics, if it applies, will take over the year, or market sentiment, and will take over that country, and those fundamentals and kind of drive the valuation of that currency at the same time. But yeah, I do consider that. But I specifically only consider that when they're actually talking about doing something with it. When I hear about
Yeah.
things getting ready to happen, and I was like, well, this might affect the trade that I'm currently in or that I'm getting ready to take. Then I'll start to like lock in on that. Other than that, I like to keep up with like what they're doing with it. You know what I mean? To make sure that I'm
Hmm.
in line with like I don't get any surprises basically. Um, or those of you who don't know about balance sheet runoffs, when their the central bank that is in charge of each respective country is able to do what's called a balance sheet runoff. And essentially what that is when how do you explain this in a way that would make most sense? Let me just show you guys. I have a simple
If
definition.
anyone's unsure what they're talking about, I've just put the balance sheets from the Federal Reserve website in the chat so
Okay.
people can have a look at that.
Okay,
I know
beautiful. Yeah.
a lot of people may be don't even know what a balance sheet is and what that is. So the question I have
Beautiful.
for you, you can carry on with the question, but how would you go about for people getting into fundamentals, especially? How do you think the best way to learn fundamental analysis is for new people?
For new people, you can find a good mentor that already trades this way if you want to, but like these things do affect the market. If you're new, I started off here because these guys they teach beginner level stuff. FX Street has been around for about 25 or 26 years plus, and they tell you why things are going their direction, and they say it in a way that's be able to understand. Before I started reading bank reports, I was on FX Street. Before I was even brave enough to, you know, look at a bank report, because I was very intimidated at first by bank reports when I first got it. I didn't know what any of the lingo meant. I was confused. But what I did was, bit by bit, I would like, what does this mean? What does that mean? I wrote down definitions, terms, like most of it's terminology, because if you don't know what something actually means, like the actual definition of it and why that thing matters, then it's going to be just basically a foreign language to you at the end of the day at first. And you do have to go through that. But like, here's an example of the week ahead of what's getting ready to go on, right? They talk about the Reserve Bank of New Zealand's decision coming up this coming week, and um, what the U.S. job report says and things like that. Obviously, since this article has been published, more data has come out, so they're just writing for it at the time. Let's go down to GDP growth is expected to decline. If that happens, what is that going to make the dollar do? Probably fall. It's not guaranteed to happen. It's just their projection based on the things that they're seeing. But um, I would go here because they say why. You know what I mean? Well, Fed minutes have much impact. There's information here that you can read and understand the context of what they're saying in these articles and why, especially with the context of what I just said to you for how these things affect it. You can take that same context and see what they're talking about. Everything they're talking about in this article is everything that I mentioned for why the currency is going the proper directions. So yeah, I would start with FX.
I think
or go ahead.
I think the biggest issue I see with fundamentals is, unfortunately, it isn't enough to say a risk on environment, for example, is this. A risk off environment is this. There's no
Right.
definitive way of ever saying if you're in any environment at all. And the unfortunate thing I think is people watch one YouTube video about. I've made this mistake in the past where I say, "Oh, okay, that's what risk on is," but it's
Yeah.
actually like it's so much more. It's like, well, why are bonds yields increasing? Why is inflation expected to increase, for example? And why are job reports increasing? And I think you broke it down really well with explaining why job reports are actually going up, rather than just knowing if job reports go up,
Yeah.
then this happens. It's you need to understand why these things are happening. Why is bonds, for example, going up in Japan at the moment? How is that affecting the yen? And that's where you can understand really and understand how to use fundamentals. It isn't enough to say AUD are going to increase interest rates. Well, I mean, it probably is, to be fair, because it's been pretty easy to trade the Australian dollar. But
Yeah.
like, I think, for example, if you want to get more technical, like USD and Euro are very, very difficult to read, in my opinion, because there are just so many people and so many articles about the USD with conflicting opinions. So I think for most people getting into it, they've got to like, you could obviously say your opinion, but they have to understand the why around the numbers and not just what the numbers mean. If you see what I mean. And I think the YouTube videos. I may just mute that person.
Oh, I'm muting, bro. It's chill.
If you can mute them, Sammy. Oh,
Yeah,
Daniel,
continue.
could you just
It's
mute your
fine.
mic?
Continue.
Is that muted?
Tunes right now.
Sammy, are you able to mute them? I don't know how
I
to do it.
did.
Daniel
Daniel
James.
James is still.
Oh, I'm muted for me. Sorry, my bad. Yeah. Okay.
Daniel?
Okay. Yeah, it's chill.
Okay,
Sorry.
there we go. Cool.
Alright, sweet.
Sorry, go ahead, Deontae. Do you understand what I mean about
Yeah, I
what I'm
understand what you
saying?
mean. I understand what you mean. The reason why these central banks, do you mean like for like the central banks themselves?
As in just like how people are reading the information correctly and how they should actually be reading the information is just sort of understanding what it means if inflation goes up, sort of thing. Like why do they need to know about, why bonds are going up, for example? Why is that important? I'd say is it's not just like the statements that like you see like the headlines, you sort of understand. You have to understand, well, how does that really impact the market?
Exactly.
If you see what I mean, and why does it impact the market? Why does increasing interest rates actually increase price and like that sort of stuff? Because then you can really build a story in your head rather than just saying, well, here's the 4 things that I look for a risk on environment. And that's the way to teach it, because otherwise it's very, it's difficult to really go into depth about it. But I don't know,
Yeah.
really, it's difficult to explain what I'm trying to say. But yeah.
Yeah, I think I understand what you're saying. The reason why people like these data points are considered and how um people interpret these typically, what a lot of people don't know, the market, they follow what investors do. Investors are kind of like the leaders of the market, and that these are like the big players, obviously, who I'm referring to, who like move the most money in the market. And if investors are also following these same moves, like for perspective, when you hike rates, let's just say for example, the reason why it makes the currency go up is because it creates investors will inflow their funds into that currency during that time because they know it's going to appreciate. Because if they want to move their money into assets that are going to be appreciating pretty much at all times, right? And then they typically are moving around their assets, their money, from different assets and things like that, different exposure all the time. If something happens over here, then they're just like, oh, I don't feel like that's safe for my money. I'm gonna move it over here to this higher yielding asset at this time. You know what I mean? Maybe I can move my money back there if something different happens, but for right now, I'm gonna move my money into a higher yielding asset. But they're not like saying that they don't want to mess with the gold or the Australian dollar anymore. They want their money in that because there's investing in stocks and things like that. And a lot of people don't know that the people that like actually invest in currency, like they have currency reserves. And there's people and big players that move tons and tons of money, especially the big players and those institutions. You have to think about all the institutions in the world, all that want to trade forex, trading Monday through Friday. That's a lot of volume. Um, but they're moving their money here and there based on whether these central banks are typically cutting or hiking rates. Because obviously, let's just say you have your money in the dollar when you're an investor, and inflation comes out and they have declining inflation, and you know that for a fact that that's going to drop the dollar overall, right? And
Mm.
you look at past data yourself as an investor, and you say, okay, let me look at the labor market data and the things that the central bank themselves consider, so that I don't lose my money, my assets, and I can lose my money right now while I have some profit somewhere that I can continue to profit. So most people in USD longs, when they get this data come out for them cutting, the investors take profit on any profitable positions they have on the dollar. Then immediately say, I don't feel safe in the dollar anymore because I know that this evidence is pointing towards cutting rates, which drops the currency. I'm going to move my money to higher yielding assets like gold and the Australian dollar and the New Zealand dollar. Let's just say, for example, right now, and again, because of this recent win from Takachi, even though her policy was very kind of looked at as a negative for the yen. Um, the they figured out their fiscal issues, and have been talking about intervention for a while there too, and it had
Yeah.
been perceived a while by the market that the U.S. and Japan were kind of working together on the intervention. And that's still yet to be seen, but the rumors are still
Yeah.
circulating. So
No,
randomly,
exactly. And
yeah,
what I'll say about the yen as well is I remember someone sent me a table saying, well, this is how you read currencies. It was basically saying, you get up the 10 yield bonds and you say, if the bond yield is going up, then the yen will go up. But then I'm saying, well, bond yields have been increasing for 5 years in Japan
mhm,
and their currency have carried on going down. That's what I basically meant in my question. I was like, well, fundamentally, yes, that should say if, for example, if the US bond market has been
yeah,
increasing, then more people are going to invest in bonds, which mean
oh yeah,
the dollar strengthens, right? But the whole
yeah,
thing is, it depends, right? Well, if you're looking at UJ as a thing to buy, the reason I bring up the carry trade so much is
mhm,
if you're saying, right, Japanese yields are increasing, I want to buy the yen. But if you're buying UJ, if the US bonds are also increasing and increasing higher than the Japanese bonds are, then actually the US dollar will strengthen over the yen. So it really
mhm,
you need to look further than just having a fundamental principle of saying if bonds go up, then the yen will go up, because that won't, if you've been doing that analysis, you won't have been making much money. So it's sort of like you need to you need to go into more depth of saying, well, it depends. Like, for example, with interest rates, are we at the beginning of the cycle of the interest rates, or are we at the end of the cycle? All this stuff actually plays quite a big role
Yeah,
into,
definitely. It definitely matters.
that's what I sort of meant. Like, it's not just
Okay,
the
I got you.
statements, it's the, well, it depends sort of thing. Because
Yeah,
I think that's what makes fundamentals hard. I struggle with it. And that's why
yeah,
everyone gets it wrong, because you can never go into everything. There will always be a reason for why price goes up or down, but you
yeah,
can
for
never
sure.
understand everything. But you just got to try your very best
Yeah,
to understand why and why it
yeah.
depends, etc. But yeah,
Yeah, it just like you have to learn about all the factors. Honestly, per currency, you have to if you're what affects that currency. There are some currencies that are called commodity linked currencies, and evaluation of a certain commodity also affects that currency. For example, the Canadian dollar, it moves with the evaluation of oil. But oil moves with the valuation of because of war in the Middle East. Typically, it goes up and down based off of that, whether there's peace there or not. So those dots connect in each other. Oil by itself is tradable, but also the Canadian dollar is linked to oil as a sort of fluctuation of what it might be, as well as the fundamental. So a lot of people don't know, like you have to figure out per currency, are the main factors that affect this currency, whether that be yields. If that's a strong fundamental, and you should always consider yields for sure, but that's along with everything else. So overall, what I do is I will go into yields, I'll go into bonds, I'll look at those things and whether they're going up or down. I'll look into central bank policy. I'll look at the actual small data points to see is it even pointing to anything significant. And if I see and I look at the overall picture once I've done all of my analysis from a fundamental perspective, between reading and seeing like the past data trends, especially, and then the current ones, then I put all of those factors together and say, yes, this is going up, this is going down. And then I check the data as well to see the reaction. Because if I don't see a reaction of it actually doing that, back here, if I don't see the New Zealand dollar going up or down, or the US dollar going up or down based on my interpretation, then I start to look at where was I wrong potentially, or is it having just a temporary reaction? So I do a lot of waiting after I've done my analysis, and then obviously look at the technicals and things like that too. But yes, he is absolutely right. You have to consider multiple factors when it comes to evaluating for your analysis. And for example, if like let's just say the central bank's cutting, right? But the yields are going up at the same time. Which how do you know which fundamental is stronger and which one will
exactly. Yeah,
actually?
that's the thing I struggle with
You know what I mean?
myself.
I,
Yeah,
yeah. So how do you know at that point, like which one's going to actually affect the currency enough to make it go the direction that it would normally go if this thing affected the currency? At that point, I go into more detail with my fundamentals and I look at, okay, there's central bank policy, and then that's what's going on with bonds and yields right now, right? If that is contrary to, like, let's just say, cutting rates and things like that, um, and the currency going down, I look at how hard are yields and bonds and things like that going up or down, depending on the situation that I'm dealing with, and is the data like the macros here for where's it? The macros here for the inflation trend, GDP. I kind of look at like past data as well and kind of get an overall trend. What has it been doing, right? If we have a bunch of data points pointing towards a central bank cutting real aggressively, let's just say for example, then but bonds and yields are up, then I'm going to consider the heavier fundamental for my direction of what's
right.
going on. Because
Okay.
not only is the central bank cutting, but there's ample evidence across multiple different small data points like inflation and GDP and whatever else is going on with that country of like, yeah, this is going to get ready to get aggressive for these cuts. And especially from that my point moving forward, that you have like data for yourself, any further data points that support your last data points just make it even stronger and create even more volatility. So
Mm.
that's kind of how I gauge my risk on, risk off environment and when it is, because if the dollar is going up, then that creates a certain risk environment, and then everyone else, like the high yield currencies like euro, kind of by default falls, and the dollar goes up. The Australian dollar by default falls, and New Zealand dollar, all the main countries falls to the dollar because the market treats the dollar like the leader, in reference to currency. So whenever we go up, everybody goes down and vice versa. And what you're seeing is exactly what I was saying earlier when investors are losing their money based on the data points that are coming out. Whenever the dollar is going up, that means some type of data point came out that was positive that may have pointed to good data from the United States that may have pointed to maybe the Federal Reserve being more restrictive, as in more hawkish, and being able to be potentially even be open to hiking rates if this came out as kind of higher than expected, showing persistent inflation. So that means you can see the investors kind of moving their money because you'll see the assets respond immediately to the data points. Everybody
Yeah.
is looking at the same time and saying, "Oh, inflation went down actually, and we expected it to go up, or GDP went down, and we expected it to grow." Gonna go call my guy and get my money out of the dollar. You know what I mean? At least until
Yeah.
the next time further data comes out, because they very much are very like particular with investors how they move their money. If even one data point comes out pointing towards like, oh, consistent cutting rates or hiking rates, that depends on that next move. And then you see them moving money into the Australian dollar and things like that whenever the dollar's down, which is exactly what's happening right now. If you look at currency strength, the dollar's down week, and the Australian dollar, even though it's in the positive overall, much better than the dollar way down here, which is important here if you see at the very bottom. So they move their money out of the dollar, and then you had risk aversion occurring, which means they are literally averting risk. One moment, I'll go grab my charger.
Okay, cool. Roman, did you want to ask your question after?
Yeah, I had another one.
Yeah, I'll put that one through. I'm also gonna ask another question.
Yeah,
Well,
that literally means that they are averting risk. They don't trust the dollar anymore with their money. You can see it
Yeah.
in currency strength, and it's the same thing with gold. Like one thing that they do is that when they do avert risk, they leave their money in higher yielding assets. Traditionally, gold, for example, is what's called a safe haven asset, and that is kind of a go-to safe asset to move your money to when things are not going well. Otherwise, the Australian dollar
Yeah.
is one. The yen traditionally is one. So that's kind of what you're seeing happening, and what really makes the market move is that central bank policy obviously influences the currency, but really it's the investors making their moves about where they're moving their money, because they're moving so much money that the currencies and the assets are kind of flipping based on what's going on here, which points to central bank policy. They consider bonds and yields and other things like that as well, but you have to like kind of bring in all the factors at once and look at everything. Okay, yields are
Yeah.
going up. Yields are going up. Central bank policy is making the currency bearish. This currency, this country is currently in the war, so that's going to affect the currency as well. You know what I mean? It depends on what's
Yeah.
going on.
I think Roman had a quick question.
Okay.
yeah, I wanted to ask because obviously all of these factors impact, like everything you've been talking about, impacts the way the currency moves.
Yeah.
But I'm just curious about when you, like, in your mental model, when you imagine you want to be jumping in, because obviously you can be like, well, the whole goal is to predict what the interest rates are going to do before they do it.
Mhm.
But if let's say the inflation numbers are high, so they want to be increasing the interest rates before that, do you want to be jumping in like after the inflation numbers come out? But then like the move has already kind of happened, because the market kind of reacts to it. So it's kind of like when do you time this? Like you want to wait for the news to tell you which direction it's going in, but you don't want to wait too long before the market has already moved. So how do you kind of balance that?
Great question.
Yeah, that's a really great question. I what I do is I don't predict anything. I do only react to what's going on. That's my whole model. I had several years of trying to predict, and I would have a lot more losses than I wanted to have at that time trying to predict things. I learned fundamentals. How do you not predict? You want to be reactive. If just because the market thinks that if certain inflation numbers are getting ready to come out, doesn't mean that that's what's getting ready to happen. That's one lesson I learned in the last like 2 years, I would say, because there are what's called data surprises. The market's like, well, this is what we think all across the board right here. This is what we think from this last print right here, and then it'll completely blow it out of the water, right?
Mm-hmm.
Sometimes that happens, and I try to only react to the data. As soon as the data comes out, if for your to answer your question, mentally, let's just say Australian dollar, Swiss franc here. For example, we had last week the Reserve Bank of Australia doing a surprise hike actually, and then they had their guidance moving forward was that they're going to continue to hike rates, especially if inflation was sticky. So that brought the Australian dollar overall long term up for now. the only thing that can really defeat that at this point for like the next several months, because they don't meet every week. You know, the central bank to make moves. They meet months down the road sometimes. There's one central bank that meets every like 90 days. At that point, I'm like, okay, the Australian dollar, the Swiss franc, right? I start to consider the other side. I already know how that affects them, and I look at all of the data points that at that point about the Australian dollar, and like why would you be wanting to hike rates at all? You know what I mean? And if I see inflation has been sticky in the past and they're having um, issues like that, and let's just say they have good labor market data while having sticky inflation, that makes it safe to hike because you don't have a kind of like a conflicting ill going on with your dual mandate where you have to handle both kind of more stressfully, to be honest, it seems to me. And I wait till the day comes out, and I, like leading up to each meeting, each central bank meeting, there's a bunch of data that comes out that either points to them either having to or being able to hike rates or cut rates. After the data comes out, I react. So the way I trade is if it's long, I'm gonna get in. Um, my entries is I'm patient. I'm a swing trader, so I can set a limit order at a point of interest where I was like, this is gonna after sweeping this liquidity, it's gonna come back and I'm gonna trade. It's gonna trigger me in for this entry, and then I plan on taking this up to a certain point. My projection for the trade in the next like 90 days is that we are going to get up to 057, about 056, 846, as long as the RDA continues to be hawkish for the next couple of months. And this is for a 3% gain, but as the data comes out, I'll scale this in for multiple entries. I don't require my first entry to be a 1 to 20. There's always other opportunities to get in and get better RRs later on throughout the month. But
This is really interesting, actually, because Aaron, who's another full-time trader in our community here, from Dubai, he's
Yeah.
a swing trader. He's very big on the scaling in as well. So he would have an initial entry, and then if he thinks he's right and getting more and more right, and the data and stuff and the technicals are leading to him to say, well, actually, yeah, price is going to continue going down, he will scale in. So how do you scale in? Do you wait for, let's say, the next inflation data to come out and say, oh yeah, we're still pointing towards AUD interest rates increasing? Would you then put another order in, or?
yeah, I would. Once that does happen, that's exactly what I do. I go with the count. Currently, I'm in this trade. You know, it just triggered not too long ago. Um, and if unless this moves kind of like away from my entry, I'll make this one risk free, and then I'll see what I want for price and what I need for price from a higher time frame perspective. But yeah, once the data comes out, if I have another inflation print, right? Let's just say the inflation comes out too high for the Australia, and the Reserve Bank of Australia that backs what they said last time, and if they say they're going to hike rates in the future throughout the year, maybe let's just say 3, 4 more times, because inflation's a worry for them, and as they're showing sticky inflation. Any other inflation reports coming out supporting a hike is super strong for that
Yeah.
currency, because you have the context of past inflation reports that are sticky, as well as what the actual central bank said for what they were doing before. So that kind of validates their reason. And then investors
Right.
are like, oh, okay, let's pour more money into the Australian dollar, you know, because we know that them being on a rate hiking path is going to make the currency go up, then their investment appreciates, you know, in that regard.
But you would wait then for the inflation rate to be high to come out, and then after that came out, then you'd be looking to get long when the technicals line up. Is that correctly understood?
Yep. And then
Mhm.
I would look at data and things like that. After that, if inflation went down, that doesn't mean I'm going to close my initial position, because it could
Yeah.
be a small decrease in it could be the trend, because everybody knows that trends, they go up and down a certain way, and if inflation is doing the same thing, it's fluctuating. It's like a trade would, it fluctuates. So if you just having a couple um increasing inflation reports is not significant, but having like a bunch of them in a row shows a trend.
Yeah, exactly. And
It could
it's
be a
showing it's going to continue rather than just stop next week, the trend. I think that's why
exactly.
AUD is quite easy to trade right now. In my opinion, I think most of your guys, if you're trading currency, should be an AUD. I took an
Oh, yeah.
AUD Swiss franc trade the other week, and just before they announced interest rates, speak up. But I think the difference with AUD is that they're not just saying interest rates will be increased in the next time. They're probably gonna continue to increase them at least another 1 or 2 times more. So that can give you, as a swing trader who's doing this approach like Deontae, where he's got a big stop loss and a big take profit, which could take weeks to arrive there. You're pretty you're pretty confident that you're on the right side of the market and price is just going to continue going up and up and up. So yeah, it's something that I probably need to look at myself and just staying in trades for longer, because then you can also reap more rewards of entering more positions and actually get a better percentage out rather than just a 2% gain. You could be, if you've scaled in, you could be up
Right.
4 or 5% just from a 2R, So
Yeah, exactly. And then typically I'll the second entry I'll try to get like a better risk to reward than I do on the first one. And the first
yeah,
one
okay.
kind of secondary to the
Do you
second
trail
one.
stops as well?
Yeah, I trade with stops.
You trail them? Yeah, okay.
Oh yeah, I trade my stops. I don't think it's gonna come back down to that
Yeah.
area. Usually based on like the daily higher time frame. Whatever's happening here. I'll trail my stop and secure a profit. So like this is an area I plan to trail my stop as I'm 2% in profit and we're pushing up. I'll keep trailing my stop. I'll
Yeah.
keep trailing my stop as the price continues, and any extra profit that I can lock in, I'll lock in with that. If I end up getting stopped out in profit, then I secure 2% for the month, you know what I mean, out of all of my profit. So I kind of think of my profit as like a more of like a monthly, bi-weekly to monthly kind of deal.
Are you trading with live capital, or do you have some funded accounts, or how is that structured?
For for personally myself, like getting getting personal capital has always been a psychological hurdle for me for some reason. I've looked kind of like the opposite. And it's somebody else's money, I seem to be more careful than when it's my money. You know what I mean? So I've always preferred to trade. I mean, I'm not saying that it's bad to trade personal capital, but you definitely should invest into a personal account for yourself. Um, but which is what I have been doing. But I just personal capital is it's a psychological hurdle for me. And there's a few areas of my trading that I still have a bit of a problem in. And I do make mistakes every once in a while, but overall, in a month, I'll typically return 10% or more every month. Yeah,
Wow, 10% a month.
last week in my own signals chat, we closed 12%, and that's because two of my trades broke even. For one was a 1 to 8. It was almost at target, and then different events happened. I tried to trail my stop to break even at that point, and I was waiting for some more data to come out to potentially have a continuation, and it just did not. So
Yeah.
it broke me out. It was a goal. It was a goal, and I had to remember it was a goal. It broke me out at break even. Otherwise, it would have been another 8% profit. I honestly should have closed it if I'm being reflective. I should have closed it when I was near my TP, but I typically like to let things run. I'll be able to target when I trade. So
It's
maybe I can
impressive
get
stuff.
better. Yeah,
Yeah,
maybe I
very
can get better.
impressive.
Yeah, maybe I can get better at managing my trades or something like that. Maybe that's a flaw of mine, but I just kind of like I have to say that trading is profitable, but it's not perfect. You're gonna always be learning in this game. You're always gonna be learning new things. I learn new things every week, and I make sure that I'm learning new things every week about trading that I need to know, especially for the assets that I trade. Coming a long way and actually like reaching profitability, and then having that continuing drive to learn from there, because it's very easy to get very complacent in your profitability. I think a lot of people do, and they stop learning, and that's what's wrong with a lot of the industry nowadays. So
Exactly, yeah.
yeah, so
People just
it's
think as soon as they become profitable, they'll be profitable forever. And it's just like,
yeah,
that's just
exactly.
so far from truth. Because if you trade, this is why I get so frustrated with the people who trade mechanical models. I'm like, if you carry on trading that mechanical model, the regime's going to change about 3 times,
Yeah.
and then it's never going to work. Like the only people who trade mechanical models are people on TikTok, who claim
Yeah,
they're profitable. But so that's why, like, the amount of stuff allows you to be fluid and allows you to trade for a long time.
exactly.
And that's why you've been
Exactly.
trading for 7 years. Like, it's not because you have a magical system. It's because you just know a lot of stuff about, fundamentals, and that's your edge, right? So
Yeah,
your edge is the understanding of what things drive price, and that's your edge, right? You can be fluid, you can be adaptive, you can take different setups here and there, you can take on different, currencies. You're not tied to Euro USD just because your model only works on Euro USD. It works on the Swiss franc. That's why I like the way we trade. The way we trade fundamentally is that I can trade corn, and if I have the right outlook on the right bias, it doesn't matter how I enter the trade, because I have the right bias that price is going to continue going up. I may get the wrong entry, and I may get a worse risk reward, or I might lose. But at least I have that fundamental reason for saying, okay, I've looked at the data, and the price should go up in my opinion. And that's your edge. It's not some mechanical liquidity breaker structure, fair value gap stuff. It's just like,
Exactly.
it's a proper edge. That's what I like to say.
Exactly. Thank you. Yeah, and like guys, like when he said mess up the entry, I'll do that sometimes too. Sometimes I'll be right on direction and interpret the fundamentals perfectly,
Exactly,
and
yeah.
then get stopped out. But that doesn't make the direction invalid. It's still the central bank is still going to do it. It's doing it. That still makes the current. That's human error. That means from where I got stopped out, I'm looking for further price confirmations from that point. And if price continues to show from that point, okay, we're still bullish, and I'm gonna re-enter. You know what I mean? Maybe you're -1% for +6% on a swing. That's fine. I'll take my 5% gain.
Yeah, 100%.
So yeah, I'm just like kind of like making everyone realize that trading's not perfect. Even when you're really profitable, you still can make mistakes. They're just not big ones. We just learn how to calculate them. So yeah, what I consider for entry is I do use order blocks and liquidity. It's just a very simple entry model. You can see kind of what's going on here. Every time for bullish, every time a swing low is swept within a trend and then a swing high is swept, that is called displacement. If you notice here, a POI is left, and then they come back down, and we'll zoom in a bit more. They come back down and they hit that POI beautifully and perfectly to the point where somebody could set a limit right here and they would have a sniper entry, maybe at the 50% where the bad line is. That's typically where I like to go. Otherwise, if I'm doing an aggressive entry, I'll do it right here on my order block or imbalance. And you can see the preciseness of that. So scrolling back, you can see this in the trend multiple times. And this is why I trade this way, because it's not just a theoretical thing, you can literally physically see it happening in the chart. Same thing, liquidity switch from bearish to bullish. We swept an extreme swing low. And if you notice, that swing low was never revisited. Instead, we came up and eventually swept the high, doing the same thing as last time. And then it came back into discount territory, which precisely hit a parent point of interest that was right there. So at the point that you have the displacement happening, the swing low first swept and then the swing high swept, there is going to be a retracement literally every single time back into the POI that was left in discount. And this is what I've noticed price wise for behavior for how price moves and where it tends to stop and start. That literally is just a science of this. Don't overcomplicate this. This is where I've seen through my experience where price tends to stop and start. And this is just how I learned price. I used to trade support and resistance. It's very profitable still. A lot of people bash support and resistance, and they should not. You can still trade a support and resistance strategy. It does not matter how you enter the market. It matters whether you can interpret direction or not, and what's really moving that currency. You can enter how you want to. It's all up to your creative interpretation of what really resonates with you. I can use support and resistance right here and know exactly where to enter. And if we can have this old resistance be my support over here and take this long up, it's just literally the same thing. So don't ever have a like this style of entering the market versus this. It's the same thing. This is just things that I've noticed because in my trading. So from this weekly imbalance, which you can see on the higher time frame, if we can get to it real quick. This is my analysis on this pair after the Reserve Bank of Australia. I think it was a week or two ago at that monetary policy hike, and it was a surprise one with the guidance moving forward. So we had weekly imbalance right here between this candle and this candle right here, and you can see that they filled it beautifully and then came up. So that was where I started my analysis from a technical point of view. Prior to that, we had a displacement happening weekly right here from the swing low and the swing high. So that's something that I noticed as well. At that point, I was like,
Mm.
this is the POI left buy
In
side. So
discount.
yep, and then it came back into discount and precisely tapped into that weekly imbalance. And just repeated the process on the lower time frames. As we
What's
go down.
interesting is every single trader I've ever seen who understand their stuff, they all trade the exact same three ways. It's either you either play the fade where you catch the pullback and you trade in an area of discount, or you catch the breakout, and there's no in between. Like you're either
Yeah.
buying prices in discount or you're buying them, breaking the structure, or as you say, like sweeping the high or
Yeah.
whatever. So
Yeah.
there's literally that's all you do, and you just find a level for your
Yep.
entry, either
Yep,
at the
and it's not-
pullback or the break. And that's all you do, you know.
That's it. It's very simple. And this you can see the same thing happening here. Between a swing low and a swing high were established within the bullish range right here. I swept that at the high, causing displacement. And price came down precisely hit that daily order block, and this, now I drew into fine tune 4 hour imbalance and discount. I could just keep moving that premium discount tool over and over again, showing you that
Exactly. Yeah.
is how it works. And I don't want people to just go repeating this because they see this blindly. I want you to understand like what is going on. The price. This is how institutions buy and sell their orders too. They want to buy low and discount and sell in premium up high here. So if you can see this happening over and over again within a bullish range, you can see the structure of the actual trend here going on here. But every time within the bullish range, we'll establish a swing high, an extreme swing high, not the small ones like this or the small ones like this in between. Those absolutely do not matter. It's one thing that I've come down to the conclusion to is that these little small ones don't matter. You trade them this way. Only the extreme high and the extreme low. In the bullish range or bearish range. I'll show you a bearish example too after this. So this would be the swing high, and this would be a swing low. Price came up, hit this. Didn't quite take it at that point, but it established a wick right here prior to that. Swept the low, swept the high. Price revisited this daily order block slash 4 hour order block.
And that was my entry right there on
And
when it came to that level.
beautiful. Yeah, so definitely continuing to fly from here. And then as you can see right here, the establishment of the swing high and swing low hadn't the taking of the swing low had not happened yet. But this is all in context with higher time frame draw on liquidity. I think I as long as the RBA is hawkish, all of these highs right here on the weekly are going to get visited. Very much so, especially this extreme high. This is the highest high in decently recent time. The most high extreme high right here. So I put my TP essentially at the top of this weekly order block, expecting this to get just ran through this high very aggressively within the next few weeks here. And it's the same thing short. Let's just let me think of a pair that's short right now. Pretty much British pound anything. British pound is $1 because they're dovish right now, at least that's for the time and their current policy. Is another trade that I'm in as well. For my third entry, it's the same thing from a perspective of short. Now this is all extreme sell side liquidity that's already been swept. As you can see right here, same thing happens. They have swept this from high. Now let's zoom out real quick and see like the bigger picture right here. Because it's like, yeah, you got a bunch of swing highs and swing low, like what's going on. And when I said the extreme high and extreme low within the trend, so this is the extreme high to this extreme low right here at this point. Or you can I guess you can technically say to this extreme low if this is where you're taking the trade. But I know for a fact that this is the most low that I could possibly find in decently recent time. I got about 3 entries in about 3 weeks, and a couple of them smashed targets. So now this is my only one left. But this is from a higher time frame perspective. We go to the daily. Same thing. The weekly did what? Swept the high right here. I didn't even mark it up. It was too far back, but swept the low right here. And these were just equal lows right here. This is the extreme low to this extreme high. This is the buy side liquidity and sell side liquidity established within this bearish weekly range. Price came down, it did the displacement lower, which at the point of it taking this would be the displacement lower. A little bit more sell side right there. Actually, no, it had displacement lower right here and then came back up into premium, which is the opposite of discount as you can imagine. So if this was where the displacement happened and it came back up to this area, you can see right here, and then continued down and took more sell side, establishing a new bearish trading range, right? I did mark up that this was premium at this displacement right here, just for context. And then you have a few weekly imbalances that became valid POIs because I knew at that point that this one was swept on a weekly that was sure within this bearish range. The only thing really left at the point of the Doge Bank of England split that was, I believe, last week, um, is this in premium but on the higher time frame? I would agree that we did indeed sweep a low right here and then came back into premium after some years, I guess you can say. And then I would agree that this was a very powerful swing high at this point, and I would agree that down here is an extreme low. So if I'm marking up some sell side liquidity, like the reason why these are marked up was from previous entries up here. And now this one really after is the only one that's valid. I keep them because I like to have a visual of like sell side that had already been swept when I left without having to zoom out constantly. So I know that when the candles ran through, it's swept. And that's a bigger sell side liquidity. So the draw on liquidity at the current time for an extra 3%, I've been holding this for about a week and a half, is right here on this extreme low. So you can see kind of how the whole displacement model with a higher time frame confirmation, and then I usually set a limit order for it to come back and behave as I showed you. Let me show you a quick bearish example for the preciseness of displacement. So we had the same thing happen here within this range. You have this extreme high swept right here and this extreme low swept right here. And prior to that, as you can see, this high right here that was left was never swept. They tried so hard, but they never were able to. And that's also a sign, as if they can't come back to this high and actually sweep it, and then come down and sweep that, that qualifies this as a strong high. That means that liquidity is shifting downwards after you see this displacement, and now you are able to establish as bearish. 4-hour block right here, price tapped into it beautifully. Even at the almost to 50% of the order block, respected it, it went down. Swing high was established, a swing low was established again with the bearish trading range. Because at this point, we know it's bearish, you know. And then it came up and hit this order block, and which I fine tuned down to a 1-hour order block as well. Kind of revisiting this general area over here to keep going down. My point is, this is repeatable, and I only act on price on things that I see repeat themselves over and over again. Like I study where are you even stopping and starting at, and why are you stopping and starting there? And based on what I've learned about technicals, this works for me every time. Do I still lose on trades? Of course, but it allows me to be a little bit more precise in the markets. And then if I don't see certain factors, or maybe I entered too early or didn't miss something liquidity wise, or breaking structure, whatever you want to call it, it doesn't, it's the same things. Then I'll know like, okay, we're 0.3% in drawdown right now, and this high was not swept. I'm gonna close this trade and re-enter. Because it's better to save risk and re-enter than not. Um, so that's pretty much my entire strategy. I do have a 50 EMA that I do have. I do use indicators, just 150 EMA. I used to have a 200 EMA as well, but I felt it's being just a little bit too conflicting. The 50 is a little bit more fast and more tight to the trend. And since I was swing trader, I thought that the 200 EMA was a better EMA to kind of consider for longer term swings because it's just better for me, honestly. I've tried 50, 20, 20 and 50 different combinations to have better entries and things like that to consider with everything. And I just haven't really found anything else better than a 200. So you can do all of this that I just talked about, the fundamentals, the technicals in context with like, oh, maybe having a rule of like it has to be under the 50 EMA if I'm selling, it has to be above the 50 EMA as well as I'm selling. Or has to be at this certain Fibonacci retracement as well. So you can add whatever confluence you want to your strategy, given that. Does anybody have any questions that they would like to ask?
What percent of your analysis do you think is fundamental versus technical?
80% fundamental and 20% technical. I would say 80% fundamental, 10% data, and then 10% technicals. Because technicals, once you kind of have your technicals that you look for, and you've been doing that same model for some years, and you stick to it, it becomes pretty easy to spot the things that you require out of a trade. And I would say it's 80% fundamentals, and that's just direction and sentiment, and whether we are risk on, risk off because these things happen, and where the money's flowing. And then once I figure that out from just reading, honestly, that's all I do is read what the market's doing. And I'm like, okay, well, at reading this about what's happening about with bonds, and let's just say, bonds are going up and yields are going up for the Australia at the same time as they're hiking. That's it. Just that would just be an addition to my trade. You know what I mean? If we have positive, yields and bonds and things like that for that respective currency, that would just be another addition to my trade. So yeah, I I consider all of the factors all at once, and it becomes it kind of like points to either one thing or another. But yeah, that's pretty much my entire strategy put into one video, of what I
Yeah,
consider.
well, it was amazing webinar, I must say. Does anyone else have any questions? I'll unmute. Hang on. I think someone is.
You have any questions about fundamentals or entering the market, or what data I consider? And
I maybe got a little question about so you got set up on Friday. Would you take it on Friday? What are your thoughts about the weekend gaps?
It depends on the type of account you have. If you have a good broker or a good platform, and if you have a day trade account, I highly recommend you day trade and don't hold it the weekend, because if it's set up specifically to be a day trading account for that platform or whatever the case may be, if that's what applies to you, and um, it shouldn't have such big good broker and a good platform shouldn't have such big gaps so from over the weekend,
Yeah.
spread over the weekend that you're getting stopped out.
Okay.
If you were in drawdown, that's one thing. You know what I mean? That's possible for sure. But I've had platforms where I could never hold over the weekend. It was impossible. And every time we hold over the weekend, like 70% of the time, stopped out as soon as the market opens.
Yeah.
And that's just kind of an indictment on them as a platform. They're not getting proper spreads and liquidity and things like that, for themselves, so they can serve to their clients, to be honest.
So, what platforms do you recommend?
FTMO has always had good spreads, even though they don't operate here in the US anymore. I still recommend them. They've always had good spreads and things like that. I think they just got a one-step swing account, if I remember right.
Yeah.
Finally. So that's
Looking to get one.
Yeah. Really, Alpha Capital is really good. I've never had a problem with their spreads and things like that. I would say Alpha Capital is like top 2 for spreads in the industry. What else? Honestly, those are, as of platforms that are regulated in my country, those are the only, like, Alpha Capital is like the only one that I trust, honestly.
Yeah. Okay. And what do you do with consistency rules? Because you are typically well, you said you have a high, like a 1 to 8. How would you go about the consistency rule for that?
You mean like how do I manage my risk on the trade?
Then, like, let's say you make £8,000 on a 100k account, and you have a 40% consistency. Do you find that being an issue with the consistency rule to get payouts, or not? You find it's okay?
I don't find an issue with the consistency rule, because I'm very particular about my trades, and if I even scale in, I have to qualify. And I don't like to take a ton of trades. Every once in a while, I have an aggressive period. I like to take a few swing trades a week, 3-4 swing trades a week, because the opportunities are just there to hold them long term. But I have kind of a less is more model, where I either am getting into a new trade, and if I'm not getting into a new trade, I'm looking to scale in the current trade that I have. Maybe I have one or two swings. Instead of opening more risk on something you have to do a whole new bit of analysis on, you can just um, continue to scale in the current trade that you have. You know what I mean? Over time, it's quite
Yeah,
literally the
yeah.
same. And it decreases your risk because the things that you've considered are still in place there, you know. And that
Right.
way, if you are getting another entry over time on your swing trade, or even if you day trade, you're getting another entry throughout the day, something developed, then it just decreases the risk because the direction's already been determined, you know, versus having to like think about another trade. And I'm not saying that it's bad to think about another trade and things like that, but like I try to keep my risk down and keep my win rate kind of like high by being picky and kind of treating trading like chess, a lot like chess. You don't just make any moves when you're playing someone in chess. You have to think about it and look at what they're doing and make sure that they do that. So whenever there's a move that actually can happen, then I make that move. And whenever there's not a move, even if it's for 2 weeks, I'll do nothing.
Okay. Josh, do you have a trade question? You have a unmute your mic. You've
To be honest,
unmuted.
I've learned more from actually Deontae himself teaching me how to use PMT. I actually can use it now, knowing what it means.
That's
Yeah,
good,
it's
man.
great
I'm glad
software.
you learned.
But nah, question-wise, nah, not really. We're
What
interesting. New stuff.
what's Deontae, what's would you say like your win rate is, your average risk? I know it's difficult to say average risk or reward because it obviously hugely depends on how long these swing positions you feel go for, but do you want to break down sort of like those statistics?
Um, my average win rate, um, last I looked for January to start off the year. This is new. This is new. This is not like it hasn't been this way. I learned a lot of lessons in 2025. So just some perspective. Um, I ended January with a 90% win rate. And February, if when all the trades hit their targets that I'm in now, which they're all in profit, I'll be at like 75 to 80. So it does fluctuate sometimes. Um,
I would actually believe you because I've also had, for fundamental traders, I don't know about you, but I think it's been pretty easy recently. Not
yeah,
easy, but it's been easier for us because we understand what's happening. I think a lot of technical guys are getting screwed over with the Trump stuff because they don't really understand what's happening with the dollar and stuff. But looking
yeah,
at most fundamental traders across the board, they're doing very well in 2026 so far. I was looking at Nick; he just came off 160K swing trade on gold. His win rate's up by 90% as well. My win rate's been close to 70%. And actually feels like losing's like weird at the moment. And I don't want, that's not me. I know that is not going to carry on and my win rate will definitely drop down.
yeah.
But it has been, I do think for fundamental traders being pretty easy in terms of like gold and stuff and reading the news. It's been pretty predictable, but I don't know what your thoughts are.
Yeah, man, it's just that less is more. You know, if I take 4 trades a month and I follow my rules every time and I interpret the fundamentals correctly, but each of those trades is, you know, maybe like a 1 to 8, 1 to 10, 1 to 5 here. You know what I mean? We're still doing a lot of game. If that's all I do for that month, I'm good to go. You know, and
Yeah, yeah.
maybe all those trades don't hit their targets. Maybe some break even. Maybe I close some a little bit early and it's not as much profit as I was going for. Some fluctuations happen like that where things may change, but you're still in profit. So you're like close your 2 or 3
Mm.
percent that you have currently.
Yeah, yeah.
Logging. But you know, there's things that kind of go into that. I manage how I keep my win rate up is I manage my trades really well. After a certain point, I move stops to break even. After a certain point, I move my stops into profit, and it allows me to. It's just that the 4 hour time frame doesn't really move super fast, you know. It allows me to lock in profit,
Right.
and then if I do
So you
get
get to
stop,
break even quite early on just to mitigate your risk and stuff.
yeah, exactly.
Yeah, yeah.
After
Okay, makes
after I see
sense.
that way it allows you to re-enter, you know, if need be, if the trade's still valid and you break even, be confident and re-enter. Maybe look for maybe further confirmation from where your
Yeah,
POI is at. I trust my trading, so if I have a POI already and it revisits it, I'm like, okay, well then we're buying from here again, and then you know I'll go from there. I manage my risk. I'll tolerate 0.5% risk, you know, that's nothing. But once you start to get 0.6 to 0.7, and I'm missing 1%, I start to look at where was I wrong on this trade and where can I preserve risk.
Yeah, that makes sense. Okay. What? Are you full time trading at the moment, or?
Yeah.
Yeah, you're full time. Okay. Is that your car? Your profile
No, I
picture.
was actually at a car show in that picture.
Okay, I was gonna say, like, damn, you've got a nice car there, but no, cool. But if no one else has any more questions, does anyone have any more questions? Then we can let Deontay go because I don't know what he has to get on.
I
But,
just wanted to ask about
yeah.
how you got to that stage where you can rely on this full time. Like, were you working half the time or working full time and trading on the side, or and like when did you take that step to go full time?
Honestly, it wasn't until I started submitting myself to God, if I'm being frankly honest. Wasn't until I started truly submitting myself to God and changing as a person, just like internally, because like obviously, if you're like a greedy person or you're like a bad person internally, trading's not gonna work out for you. You're gonna have too many things inside of you that are going to affect your trading. It wasn't until I submitted myself to God and started submitting myself to God for real, that I started to become successful in trading. I started trading when I was 27 and I'm 34 now. I was like from like day one, week one to today. It's been 7 years. And I got my wife today. She's my wife now, and the mother of my kids. She introduced me to God when I met her, and she was just my girlfriend. And I had been raised in a church, when I was younger. But like the people that I'm not pushing religion on anybody. I'm not gonna do the whole spiel. Don't worry. But I'm just trying to tell you my story about how I came about trading and what got me trading. I hear from God. That's no different. That's just something else too. I hear from God. I hear from God, the God who created the entire earth and universe. And he had to work on me for many years, my greed, my pride, my things like that I had before he ever was releasing trading to me. And I was frustrated that entire time. You know what I mean? I was frustrated that entire time because it was like I was profitable, but it was also being held back because of me and things that I was lacking that he didn't approve of. And it wasn't until that I started to kind of really submit myself to him because he let me know, like, dude, this is not going to work out for you. This is what you're meant to do, but it's not going to work out for you until you meet my requirements, basically. And it wasn't anything bad. It was mostly just like, don't be a crappy person. Long story short, do not be a crappy person. I used to be a bad person back when I was, much younger, and I wasn't really as level-headed and calm and mature as I am today. So I had to get a lot of that out of me before I ever became successful in trading, even just on a personal level.
Yeah.
You're not gonna be able to become successful in trading if you're bad with money. If you currently are not handling your job finances or whatever you do for a living now, it's not. How do you think you're gonna be able to handle $100,000 payouts or $20,000 payouts? It's gonna be impossible. Oh, I had to develop a lot of things and within myself to become successful at trading. I had to really kind of like step out of myself and face myself and say, like, enough is enough. And that's honestly, it was nothing that I did personally to become successful at trading. It was given to me after many years of refinement through God. And
Right.
that's my personal story about how I came about in trading. But from like a perspective of like putting in the work, um, I studied just technicals at first, and that only lasted so long. I'm not saying technicals are bad, but for me personally, my story is that only lasted so long for me, so many years before things in the world started happening, and it forced me up to learn fundamentals. And here I sit today, um, after many years of lessons and L's and things like that, trying to learn fundamentals, coming from being like not like super profitable, but like I was above break even most months. And it it kind of pummeled me, to be honest, and it's kind of set me down for a bit, and made me learn new things. Which challenged me, kind of grew me into the trader that I am today.
Right. And what sort of, you're obviously from the US, so it's sort of a similar economic state to the UK where some of us live, and a lot of us live in the US as well. But um, you obviously said it took a few years, obviously, to get full time. And would you say there's like an amount of, I know there's no like fixed amount of money that you need to, in terms of capital to become profitable. What would be the range of capital that people could be saying, right, if I get to X amount, then I could look to quit my job
Okay.
in
I would
capital?
say I would say bare minimum 100K. You can kind of have a 50K, you know, do you full time, but that will depend on how much you can return and where you're sitting at right now and kind of what you want to do with your lifestyle. If
Right.
you want to make $10,000 or pounds a month, and you want that to be your take home after your profit split, or maybe from even from your personal account, and let's just say a funded account, since that's where most people like to trade these days. That's what's most popular. Um, how much is that? That's like 816, about 20% a month. So if you can average about 25% a month or more, you know what I mean?
Really, it's quite a lot.
Consistently, yeah, it's
Yeah.
quite a lot. So it becomes kind of like because that's not gonna happen every single month. You know what I mean?
No, I
And
know.
at that point, I would say $100,000 is enough to kind of be full time, because at that point it kind of decreases the burden of if you were living a lifestyle where you were maybe going a few $1,000s or pounds a month and paying that's all your bills that you have right now, and you can just even make $2,000 more than that, or £1,000 more than that, per month with your profit
Yeah.
account. That's doubling your income, and then at that point you have to focus on the scaling of the account. Hitting whatever their scale is. Some prop firms say hit 10% in 90 days and we'll scale you by 50%. Because that shows you like the shortage of talent out there in the prop firm industry. They're rewarding like people for 10% in 90 days. That's only a few percent a month. It's not that much a month, so they're not really
Yeah. Yeah.
requiring a lot out of the profitable traders in order to scale up. And at that point where you're hitting 100K, 150K, 200K, and you're still returning that same, let's just say 10% a month, it becomes a different number at that point that you're scaling your account. And maybe once you do pass the challenge and get the account and start to get payouts, I would say within 6 months, if you're consistent and you're hitting the milestones for what they require to scale, you could 3 to 6 months you could quit your job.
Yeah. Yeah.
Yeah, yeah.
After becoming funded, not after starting trading, I'm guessing.
Yeah.
After,
Yeah.
yeah. Well, no, I also think it's a difficult question because like some people are more consistent and make better returns than others.
Yeah.
Like I know, for example, Nick would make 25% a year, but that's because he's trading $1 million in capital, right? So he's not looking to try and make 10% a month, because at that point it's actually quite a lot of risk to him, because he's
Right.
risking a lot to make 10%. He's only
Right.
risking 0.2, 0.3%. So obviously he's not going to be making 10% a month. So I think it depends on your risk parameters and how much you're willing to risk. I think people naturally on live accounts, their personal capital risk less because
Yeah,
it's their own money. Obviously, funded accounts, you can risk 1-2% without really worrying too much, because you're only putting 300 quid down for a challenge. So you can make those 10% months. But I think it just depends as well how consistent you are and how much percent you've been making on average. For,
it definitely does.
yeah. But cool.
Yeah.
I think, is there anything last you'd like to say, Deontae, before heading off?
Just
Or
one more thing
yeah,
I'd
yeah.
like to add, just from a technical perspective. Um, in reference to everything I said about how displacement happens, um, prior to that, there has to be within in premium or discount, whichever one applies, a, a major sweep, as you can see that happened here. And what these are called when these highs are not broken and these displacements are happening, they're called high resistance liquidity voids. And that essentially means that every time a displacement happens, unless like news or fundamentals change suddenly and say otherwise, highs are not going to be broken. And you can bet that every time, as you can see, it's going to come back into an area. That's why breaking retest works so well. You can see right here, if I were to draw that in, the retest would be beautiful in this area. And could actually stop like right here or something like that, whatever you decide to do. And it shows you the preciseness, but it's a bearish high resistance liquidity void and a bullish high resistance liquidity void. And these only happen when you have price basically going down to the bigger picture, drawing liquidity for that. More of the situation is so that's what I wanted to kind of give you guys parameters for when this does happen. The liquidity has to basically have to be shifted, actually, the bearish and bullish respectively.
Okay, cool. Nice one. Okay, well, if no one else has any more questions, then I don't want to keep people for too long on a Friday And yeah, I think that was a really great webinar, Deontae. I think Sammy managed to record it. On his
Yes, yeah. Thank you very much. That was good. Very good.
people with we can send over. But yeah, thank you so much for the webinar. I've learned personally a lot. It's good to learn from people who are even more experienced than ourselves, and everyone's at a different point of their journey. So yeah, thank you. This is exactly why I do these webinars for me to learn and for other people to learn as well, from people who from different backgrounds. And you obviously say God played a large role in your profitability and stuff. Everyone has a different, meaning or why they trade and how they trade. So it's interesting, to get people in, and I'm sure we'll make more webinars. But feel free to send the community and post your ideas, and I'm sure people have questions for you coming forward. But yeah, hope you guys enjoyed it, and we'll see you guys soon. Thanks a lot.
Thank you, man. I learned a lot. I appreciate it.
Yeah,
Yeah,
thank
it's a
you.
really great one. Cheers. Thank you.
Cheers.